This is the current federal tax developments this week, brought to you by the Loscalzo Institute and your state society of CPAs. Well, this week we're going to do something a little different because we have a rather massive tax bill that was dropped on us late on Friday afternoon. I was actually in Miami, Florida at the time the bill came down. So I got it as I was finishing up a session there. I was getting ready, going to travel back to Phoenix on Saturday. So Saturday I was able to look through the bill. And actually, the catch was it was 1,097 pages of a combined bill and the conference committee report. And it's about half of each when you look inside that document. So what we're going to do this week, which is a little different than what we normally do, is I'm going to go ahead this week and we're going to actually do two different sessions because I think the time involved in this is going to tax your ability to actually sit through and listen to all this. And hopefully we can get them both ready to go, but at least I want to get this individual one ready to go so we can take a look at what's going on. So you might consider this just like a double up week. And I guess since we're heading to the holiday season, in case I don't get one out due to the holiday weeks coming up, we'll just say that this is banking one in. So we want to take a look at both sections here. This first one's going to take a look at individual changes in the Tax Cuts and Jobs Act. So that particular bill. Now, for those of you who may not be aware of the bill was actually released 12/15, December 15th. We got the conference committee produced their report. The conference report was posted at about 5:30 p.m. Eastern Standard Time on that date. Again, 1,097-page document. It is available, I know for sure, at least on the House Ways and Means Committee site. You can grab it. I'm sure it's available on the Senate Finance Committee if you dig through the right places. The final conference bill was really based much more heavily on the Senate version of the bill. There are some items borrowed from the House bill, but not surprisingly, because it was tougher to make the bill meet the Senate's budget rules, and the House bill clearly was nowhere close to meeting those rules. It's not surprising the final bill. I guess the good news, if you're a House member, yeah, you're not going to give in to those Senate people and, follow their rules and force yourself to write a bill to go with it. The bad news is if you actually want a law, you pretty much gave control to the Senate on the law you're going to get. But hey, them's the breaks, right? So it appears that we have sufficient votes to pass this in both chambers. As I begin recording this is on Sunday afternoon, about 1:45 Phoenix time, or Mountain Standard Time. I just saw an announcement that Senator McCain is going to be coming back to Arizona to be with his family over the holidays. Obviously, you're probably aware he has significant health issues. So it appears that will be one less vote than they had before. It is, the statement had been made, and certainly certain reports, and this would seem to confirm it, that one of the things that persuaded Bob Corker to announce that he would vote in favor of it was to basically allow Senator McCain not to have to be there for the vote that would be taking place this week. So, bottom line, it appears we may very well have a 51-48 vote in favor of it when the Senate comes up. But so far, nobody is making statements they're not going to vote for this bill. There are no significant numbers in the House. There it would take a relatively reasonable sized revolt to beat back the bill. And there certainly have been no statements from what you might consider the usual suspects in the Senate stating that they are not going to vote for this bill. So while it's not over till it's over, we certainly appear to be very close to a real bill. And looking at this today, now I want to talk to you. We've talked about this bill the past few weeks. We've talked about what's been in it in the various forms, what's been added, what's been subtracted. Now, that was important because we're trying to do planning. We're trying to work with our clients. But I want to make something very clear to you about when working on this bill, what we're discussing today. You need to start at zero on this bill. There are a number of things we have discussed over the past couple of weeks, especially in the House bill, that simply are gone in this bill. So the fact that I don't say something, don't take that to mean that it's in the bill. Don't take it to mean it's out of the bill, I say for sure either, because I'm certainly not going to talk about everything. It's going to be tough enough for you to kind of, keep in your mind all the pieces we're going to talk today, and probably you won't anyway. It's one of those things you want to go back and review. But, just go back and check. Do not assume. Therefore, lots of things are gone. There are a couple of big things, though, I do want to mention, not in the final bill, that were concerning a lot of people. The House provision that would have caused a tax to be imposed on tuition reductions, which was really causing a lot of grad teaching assistants to, shall we say, freak out. That provision is gone from the bill. So that's not a problem in this bill. Also, one that caused problems for other people. In fact, one person I was talking to the day after the House bill was released, I was presenting at a firm, and this is a CPA that had a sale in progress, was a change in the rules for the sale of personal residence. Despite that being in both bills, that did not appear in the final bill. So again, start from scratch. What you need to do is get the conference report and actually follow through for anything of significance. Like it or not, that's the best document we're going to have for a while here. While all the tax services are working on documents, all of us here in the CPE world are working on webinars and, live sessions we'll be doing and all those other neat things. For the next week or so, because by the way, it is the holiday season, so a lot of people are off and gone. Probably you need to realize that the conference report may be the best thing you've got. We expect this bill, if all goes according to plan, it should be voted. Now the schedule I hear is it would be voted in the House on Tuesday. It would be voted in the Senate on Wednesday. That would set us up for a signing by the president either on Thursday or more likely Friday, because he usually take a couple of days, get the right people invited, to the signing ceremony, get the pictures and all that stuff going. But presumably the president really wants this signed before Christmas, because obviously that's a date that's very nice to, tell people, yeah, I delivered you a Christmas present. So we'll expect either Friday or even maybe into the weekend. I don't know. Maybe he signs it on Christmas Eve. I have no idea, to make it a Christmas present. But I would expect that before we start the following week, before we get to New Year's Day, before we get to the week that will include New Year's Day, there will clearly be a brand new tax bill. So we'll kind of look at that unless something goes very wrong from what it appears it's going right now here on Sunday afternoon. Now let's talk about some of the key provisions. First thing I want to mention to you is we got the individual tax rates. We have 7 brackets. So they use the 7 brackets, not the 4 brackets that the House had. We did get rid of that, that crazy bubble rate at $1.2 million. That's not here anymore. The 7 brackets top out at 37%. Capital gain rates remain the same. The actual brackets, now I will be printing out a version of the slides I'm using, and I'm going to upload that to the Current Federal Tax Development's website for each one of these two. So I'm going to hopefully get that up and going here relatively shortly. So you should be able to download this as a reference. But we're going to have for single individuals, again, there's 7 brackets. The top bracket will start at $500,000. And again, the rates are going to be 12, 22, 24, 32, 35, 37. For head of households, same basic structure. $500,000 is again where you're going to kick in 37%. Obviously, there are some differences until we get up to that level. Married couples filing a joint return, they'll go to 37%. You might have thought $1 million, but hey, Congress cannot avoid giving us a marriage penalty. So they'll go over 37% at $600,000. The married couples filing separate, obviously, that's 1/2 of the married joint schedule. That's going to kick the maximum at $300,000. And trusts and estates, they will hit the 37% at $12,500. Remember, nothing in here is going to get rid of the net investment income tax. So that 3.8% tax will still potentially be on top of all of this. Nothing has changed that in this bill. In 2026, the rates revert to the old rates because this is part, remember, many things in this bill on the individual side are only going to be in place through 2025. Then they would revert. They did not decide to change the capital gain rates or brackets. That's important to remember. However, they did add a new due diligence requirement. Remember those we have, that you have to get all that information if somebody has a earned income credit. We've seen those. I don't see many of them. So I usually saw like one every year. maybe where somebody kind of broke even by accident, we got an income credit. But you remember also last year you saw it a bit more for the child tax credit, an American Opportunity Credit. It's now going to be added for every taxpayer who claims head of household status. You'll have to get that sort of information to document your due diligence. If you fail to do so, turns out the taxpayer should not have been given head of household status. Tough luck, guys. You end up having to pay a penalty. The standard deduction and exemptions, those increase, and they use the Senate numbers here. They were only $200 off from the House. Doesn't really matter dramatically. So the standard deduction is going to go to $24,000 married filing joint, $18,000 head of household, $12,000 for everybody else. Remember, we again lose all personal and dependent exemptions. We do retain the additional standard deduction for the elderly and the blind. That's not removed from the law. And again, expires after 2025. Now, and pardon me for that, I've picked up something on my way across country. The qualified business income deduction. This is a really weird one because it looks surprisingly simple initially. It seems easy, and we all heard about it first. Yeah, we're going to get this basic subtraction for flow-through income. Sounds easy. There's a lot of complexity under the hood for this thing. Well, the basic issue, though, is, yeah, we get a 20% deduction for qualified business income. That's basically pass-through income from a Schedule C, from a partnership, from an S corporation that ends up flowing onto the individual's return. So if they get $100,000, they'll get a $20,000 deduction. Now, qualified business income is business. Now, it's not investment income. It's not dividends, interest, all that stuff. But business-related income, other than in certain specified pass-through businesses, and even that gets an asterisk. So we'll talk about how that goes. But the actual definition of qualified business income has many quirks. There are special cases, and there's a special limitation that is based either on wages or invested capital. Let's start first, though, with this qualified business income. The problem here is this specified service, trade, or business. If you're coming from a specified service, trade, or business, then you don't get the 20% if your income, taxable income, is too high. Now, it phases out ratably. So you lose your 20% ratably over a $50,000 range based on your taxable income, of course, without this special subtraction. If your taxable income goes above $150,000, $157,500 for a single head of household, married filing separate, and that goes up to $207,500 for those groups, then you lose your 20%, right, ratably. So obviously, we're going to lose 2% as each time we go 1,000 up until we finally lose the whole thing. For a married couple filing a joint return, it'll go from begin to phase out at $315,000 of taxable income. It will totally phase out at $415,000. Another question is, what is a specified service, trade, or business for which we have to worry about this phase out? Well, it's a business in the area of health, law, consulting, athletics, financial services, brokerage services, or any business that depends on the reputation of one or more owners. That last one's borrowed straight from the 1202 rules that we had for qualified small businesses, where we could sell off the C Corp and have no gain at the back end, but it couldn't be one of these reputation businesses. We've never really got a good definition of reputation business, but it's back again. Interestingly, what was dropped in conference was the list used to include architectural and engineering services. Those services have been removed from the specified service, trade, or business list. So if you have clients who are architects or who are structural engineers, they're going to get the full 20% no matter how successful they are. It doesn't matter what the flow-through income looks like, they're going to get the full 20%. Now remember, the 20%, as I said, is on the flow-through income from the various activities. Okay. Now, the other limitation here is a wage and capital limit. The deduction is limited either to 1/2 of W-2 wages or using what's called the alternative test for this, for those above the threshold limit for service business. So remember those phase-out limits for the service business, that taxable income limit? Well, those limits are also going to determine if the W-2 test comes in, and if it does, then the W-2 limits are going to start phasing in again over that same either $50,000 or $100,000 range. Once you're fully phased in, again, right? Obviously, because of that phase out range, we get fully phased into the W-2. We don't worry about service business because they're not around anymore. So this is non-service business where this is going to be the bigger one. You're limited to one, deducting a number no greater than the greater of 50% of W-2 wages paid by the enterprise, or 25% of wages, and 2.5% of the unadjusted basis of property used in the business that had been acquired no more than 10 years ago. How's that for an odd computation to get? What happens here, this is an odd borrowing. The wage limitation was borrowed from Section 199. That was the domestic production activity deduction. Remember that one DEEP had? That's going to be repealed. But this quasi replaces it, is their view. So they wanted to borrow the W-2 test from there. And this secondary test with capital is the lone shout out to the rather complicated system the House had, where invested capital was one of the ways that you basically could qualify to get a larger deduction. So we have a shout out to the House indirectly via this 2.5% of unadjusted basis of property calculation. That comes from their issue. So again, you got this secondary limit to go in. There are additional, you think you have enough special rules. There are more special rules if you have flow-through incomes coming from real estate investment trusts, cooperatives, or publicly traded partnerships. So you'll need to, take a look at the details for that coming out of each of those for purposes of getting your 30% deduction. And here's the final neat bit. This deduction comes off of taxable income. It's not used in computing AGI, and it's not an itemized deduction. So you don't have to itemize to get it, but it doesn't reduce AGI. So anything AGI limited is not impacted by the 20%, right? Whatever is AGI limited, you're going to get clipped with a 20%. The 20% is not going to help you reduce AGI. It's going to be one of those odd things to work with. As I said, it's just one of strange area of the law. We'll need to get rid of this. Now, the conference bill also allows trusts and estates to claim this deduction. The Senate bill specifically prohibited allowing trusts and estates to take this deduction. So, the Senate would not allow trusts and estates. That concerned a lot of people, especially if you had electing small business trusts. The final conference bill removed the prohibition on trusts and estates taking this deduction. Well, let's go on to the next fun thing. By the way, the funny part about that is a very quick run through that. Probably you really need, I'm thinking about looking at courses developing in the area. We're going to be spending quite a bit of time working through that much more slowly as to how this is going to work. But for right now, we're trying to get through the whole bill. So we're going to tell you this, just understand if you have to deal with that, and we're all going to have to, you probably want to go start looking at that in the conference committee report. Now, the child tax credit. This was the piece that on Thursday looked like it might derail the bill, although by Friday midday, they had come to an agreement. The senators in question, Senator Marco Rubio of Florida was the main one because he announced he would vote no if this wasn't changed to his liking. And Senator Mike Lee of Utah was also reportedly didn't like them not changing this, but he hadn't said he wouldn't vote for it. Turns out Marco knew that he was in a great position to threaten, so he did. And he got what he wanted for the most part, not the whole thing, but a lot of it. The child tax credit is temporarily increased to $2,000 per year through 2025, and it's partially refundable. We also have a $500 non-refundable credit for other dependents on the return. The maximum refundable amount is going to be $1,400 per child. It's based on your payroll tax withholdings if we go beyond your income tax liability. Now, some of you may remember there was talk of moving the age of the child up to 18. Nah, it stays at 17. So the age is the same as under the current law. But the phase out is a lot higher. The phase out is now up to $400,000 for a married couple filing a joint return, $200,000 for all others. I guess that's good news, except it means you're going to be doing more due diligence again because we're going to have a lot more people qualifying for the credit. Now, we hit our first anti-abuse provision. This is a bit of a fun part of the bill. The law has a special rule that denies an excess loss to a taxpayer. If a taxpayer has an excess loss, it will be denied, and it will be added to the taxpayer's net operating loss in a subsequent year. Oh, by the way, we won't cover this in this part of it because this is a business issue. But by the way, don't worry about the fact this doesn't affect NOL carryback, so don't need to have any issue with that because, as you'll discover in the business side of this, we don't have NOL carrybacks anymore. The excess loss trigger is losses that are being claimed by the taxpayer on their return in excess of $500,000 for a married couple filing a joint return or $250,000 for all other types of taxpayers. We also have a number of changes that were made to 529 plans. Now, we did not do a whole lot of, the House bill basically ripped out all the education stuff and, gave us 529 plans, American Opportunity Credit, and pretty much everything else went away. That's not what's happening here, but they did borrow a couple of concepts. First, up to $10,000 per beneficiary. Now, that's not per account, so make sure you understand that. If a beneficiary has if the kid has 5 accounts that the kid's a beneficiary of, you got to spread this 10 grand overall. In essence, you can't take 10 grand from each. It's 10 grand per beneficiary. May be used for elementary and secondary school expenses. So remember in the House bill, they got rid of Coverdell IRAs, or Coverdell Education Savings Accounts. I still call them Coverdell IRAs. That was the original name, right? Education IRAs. Yeah, they're education savings accounts. We still have those, but they did go ahead and agree to tag on the elementary secondary school deduction, payment items here to 529s. I guess that's a good thing. But as I've often thought from a financial planning perspective, we're trying to build up that 529 save for college. If I've got other available funds to pay for the elementary school, I might as well do it because the tax deferral is not going to run very long before I hit elementary school. It's going to run a lot longer before I hit college. So my gut's still I like the 529 for college a lot better, but also we'll be allowed to take money out of the 529 plans for certain homeschool expenses. That includes curriculum and curriculum materials, books or other instructional materials, online educational materials, tuition for tutoring, but any tutoring fees must be paid to an unrelated party. Mom and dad can't take money out of that themselves to pay themselves to tutor the kid. Can be used to pay for dual enrollment in an institution of higher education. Also, educational therapies if the student has disabilities. They also included the provision that would allow you to roll over from a 529 plan to an ABLE account for a qualified ABLE beneficiary. Now, the rollover must come from a 529 of which the owner is a beneficiary or from a family member's 529, right, that would be eligible to be transferred to this beneficiary. If you could transfer the 529 to the beneficiary, then we could just skip the transfer, but roll from that 529 to the beneficiary. The likely reason for doing so, we have a 529, we've got a child with, with special needs, what we usually use a special needs trust for, but we haven't set one up. Unfortunately, in the back of my mind, I keep wondering about, we didn't set up a special needs trust. And the most likely reason we didn't, we used 529, or we used, the special ABLE account was because we didn't want to pay for the trust work, but we have excess funding 529 plans. Well, if you have that, we can do it. More likely what's going to happen now is we do have excess funded 529s, And we'll have to transfer those to an ABLE because we can't get them to special needs trust. But we can get them to the ABLE account. Now, one caveat, this is not going to be simple because it's still subject to the annual contribution limits on an ABLE account. And if it's actually coming from the beneficiary's account, it appears that we can get an additional amount in there. The Senate added some additional money for the beneficiary to make a contribution to their own 529. But if it's coming from our relatives, I think we're just going to be stuck. We're going to eat into that maximum that could be contributed by anyone else. So we're not going to be funding money into the ABLE. Again, it'll work in some cases, but obviously most clients, most clients we work with are not working with a relative that is ABLE qualified. Because again, it's not just being disabled, but you had to be disabled early in life to make it. And then the other issue is that, we're also looking at many cases, those that we do work with, they've had special needs trust and other issues to work with. Now let's get to some of the bad news, itemized deductions. But we start a little bit of good news. The overall limit on itemized deductions, the P's limitation, that had barely come back, it's now repealed. Although, again, only through 2025. They split the difference on the home mortgage. Actually, we got a little bit more from the Senate. We got a little bit more from the Senate side than we thought we would. Than we would have by splitting the difference. But we still basically did. The Senate had kept the $1 million of home acquisition debt, interest, gotten rid of home equity debt. The House had gotten rid of home equity debt, kept the $500,000 limitation, and said, or basically it knocked it down to $500,000, not $1 million, and had said that you could not have a second residence. So it had to be your primary residence. The House, what we now have is we keep basically the current law on acquisition debt, which means we can still have a second residence, it would appear. But we only get $750,000, so not $1 million, not $500,000. Existing loans are grandfathered. You do not get any deduction for home equity debt. Again, existing loans are grandfathered, but no new loans will get that. And this continues through 2025. The other change that we all knew was coming, we have the $10,000 deduction for taxes. But in the final bill, it was changed. Again, this has been the tough one that the House was having issues with because of Republican congressmen from high tax states. Senators, if they're Republican senators, they're not from these high tax Democrat states. Well, which is, are obvious reasons, because they have Democrat senators, and so we don't worry about that. But if you're a Republican senator in California or New York, you're suddenly really worried about losing the deduction for state income taxes. So we have a bit of a compromise. Originally, it was going to be for real estate taxes up to 10 grand. Now what we have is you have the aggregate of income taxes and property taxes up to $10,000 can be deducted on your Form 1040. That's good news, right? Now, there was some discussion from people of doing something, and there's a number one rule. Don't ever discuss planning options with regard to a new law before the new law's ink is dry and the committee hears about it. Committee heard about people planning this. There were some people planning to to send in estimated tax payments to state agencies for their whole 2018 income tax and have that deducted before the end of December on their 17 return. Hopefully, you haven't told any clients to do that already because the law contains a provision. Any amounts paid before the end of 2017 on 2018 state income taxes are treated as paid in 2018. It's anti-abuse rule. What will be interesting is, though, I would not be surprised to the IRS interpret this to say that if you end up being overpaid on your 17 taxes, and you attempt to apply that to 18, that they will treat that as wait, you prepaid 18. Or maybe just any refund will be treated as an attempt to prepay 18. And it may be that rather than getting the deduction on 17 and picking up the tax refund next year, you may end up just not getting the deduction this year. It'll be interesting to see if how the service interprets that rule. But that rule was added at the end because they heard the people commenting, so I decided to shut it down. Personal casualty losses will only be deductible if attributable to a federally declared disaster area. That's again through 2025. And wagering losses are now limited to wagering income. We thought they always were. Aha. But it counts all, not just placing the wager, but like the travel to and from the casino, the things professional gamblers were taking, not going to work anymore. Now, charitable contributions, a couple of changes here. First, if you have clients that always hit that we're hitting the maximum of 50% of AGI, we're going to go to 60 for cash contribution to public charities. However, if you have the clients who are buying those season tickets to college football games, and they were paying seating rights to the university, and they got an 80%, you got to take 80% of that as a charitable contribution. Not happening anymore. Those will be gone effective next year. See how the universities react to that, but yeah, they'll be gone. They'll also repeal the option, which was never set up with the regulations. There was never a way to do it. But theoretically, organizations could, instead of having to give you current documentation that you had made a contribution, they could have somehow reported on the 990 that you've done so. Yeah, that never went anywhere. They've pulled that from the law. And through 2025, no 2% miscellaneous itemized deductions will be deductible. Okay, that does mean your tax preparation fees. That means those fees for the investment advisor and all those other neat things. That also means employee business expenses are not deductible. But medical expenses, hey, we're getting a break there. This even affects 2016 or 2017, I should say. 2017 and 2018, the limit's going to return to 7.5% of AGI for all taxpayers. So 17, 18, 7.5% of AGI. Now 19, it'll go back to 10%. Also, the AMT limit will be set at, will stay at 7.5. There'll be no AMT adjustment. Now that, kind of lets one cat out of the bag that you probably already knew. Yeah, we still got an AMT. That whole repeal the alternative minimum tax that I suggested was very likely to become like one of the victims of looking for funds. Yep, it's become the victim of looking for funds, the individual AMT. Alimony. This they did take from the House bill, except they pushed it back a year. So for any instrument executed after December 31st of 2018, so we have one more year, right? This is not going to be, so 18 agreements will still work. There'll be no deduction allowed for alimony paid on a post-18 agreement, and no amount of that alimony received will be taxable income. Obviously, they pushed the date back because, not surprisingly, a lot of people said, wait, we're negotiating this divorce. We knew the divorce was coming. We're negotiating in November, and you guys dropped this bombshell on us. And, we're not going to be able to get it done. And now it's become a disaster because, we might or might not get it done by the end of the year, but if we don't, then the alimony won't be deductible. So we got to go back to square one. And yeah. So they're going to give these people to the end of 18 to get it straightened out. But you should be aware, and by the way, hopefully family counsel, people who do divorce cases will become aware that this 2018 deadline is coming. The tax treatment of alimony will switch radically. So, there may be a press again to finalize some divorce agreements. There's going to be a deadline always. So it'd be interesting to see some of the negotiating ploys to get taken right at the end of 18 agreement in. Moving expenses, not deductible, right? And no exclusion for employer moving expenses prepaid. There is a special rule, though, that will apply to certain moves of members of the armed forces that will allow them to still, either get it paid by the employer tax-free or take a deduction. If you have anybody affected by that, take a look at the conference report. Congress felt that people were abusing the right to recharacterize Roth IRA rollovers, so that is also biting the dust January 1st. Beginning January 1st, 18, if you roll over from a traditional IRA to a Roth IRA, you will no longer have the right to recharacterize that as a rollover to a regular IRA account before the extended due date of your return for next year. Remember the old line? We'd do the rollover, then we'd see if the IRA account went down in value, and if it did, we would recharacterize it and then try the Roth conversion again at a cheaper tax rate, a cheaper tax because it was a much lower amount to be converted. Well, guess what? That's how this one's going to work. So, it doesn't work anymore. You can still recharacterize contributions from a Roth IRA to regular IRA, but you cannot recharacterize, rollovers. They also put a special rule in if you have a rollover related to a deemed distribution from a loan you had with a qualified retirement plan. A taxpayer who has that can now extend the due date for rolling over their deemed distribution due to a plan loan offset. If they won't just be 60 days. The hitch happens lots of times. The employee's not even aware until they get to 1099 that there was a loan offset. They figured they just put the cash in they got. Well, now suddenly when they find that 1099, they will have until the due date of the return to get that. Hopefully they know earlier. And even then, what it does is it gives them time to arrange for some other way of getting cash to cover whatever the shortfall was they were paying for with the loan in an IRA. Again, they have to do it by the due date for filing the return for the year deemed distribution, but it gives them a little bit of time. Finally, we've got a few things here at the end. Let's go a little different. Estate and gift tax. Okay, big ticket. Okay, let's get the big news out of the way right up front. They did not repeal the estate tax nor the GST tax. Generous Scarcity Transfer tax nor the estate tax, they're both around. However, we are going to double the exclusion for those dying beginning in 2018. At its inflation adjusted factor, we're doubling. So it appears we're going to get $11,200,000 next year, which of course would be subject to a portability election. So that means we're looking at $22,400,000 for before an estate would be taxable for a married couple if all you do is I love you wills and portability. It'll continue to be inflation adjusted. Now, again, in 2025, we drop back again. We've been down that road before. But certainly if this number stays in place, and let's face it, they're all betting it will. If the number stays in place, then, we already had a major reduction in the number of 706s that had to be processed or sent to the IRS. With this will take it and basically wipe out like 90% of those that were currently filing. Okay, that reduced number. So primarily 706s, which I found going around the country, primarily these days, if you're not in a state that imposes an estate tax at a much lower rate, and a number of them do, but again, it's a minority of the states that impose the tax, you aren't doing many 706s anyway, and in this case, you're going to even do far less of these. The bad news on this side is, some of the states like New York were creeping up and we're aiming to get to the federal level for exclusion. Well, now when the feds double it again, will New York agree to go higher? Maybe, maybe not. So maybe there'll still be that crazy differences. So, New York's trying to catch up, and then, they go and move the goal line again on the federal side. The alternative minimum tax. Well, it went right to the precipice. It was about to go over the edge. And then out of the blue, they decided we need money. And so it was saved. And I'm not sure we're happy it's saved, but it's saved. It is modified, though, pretty heavily. The AMT, individual AMT, stays under the bill. The corporate AMT does go away. We're going to increase the AMT exemptions to $109,400 for a married filing joint taxpayer, $54,700 for somebody married filing separate, and $70,300 for all others except estates and trust. But what's really nice is the phase out of that exemption now starts at $1 million for married filing joint and $500,000 for all others. That means we are going to have a very, very significant exclusion. And a lot of things that triggered AMT in the past aren't there anymore. Like state and local income tax deductions. We can only get $10,000 there. We're going to have $109,000 exclusion. That $10,000 is not going to trip us unless we got something else. to cause us to fall into the AMT. So I still think you're going to see a 6251 on a lot fewer returns, but it's not really gone. It's there. And certainly you got to watch out for preferences. The other side you start worrying about is, does Congress start adding preferences in again as a backdoor way to raise money that they figure nobody will understand? But for now, in any event, there is an AMT. It's not as bad as the old one. That may be faint praise, but it's not. And I really expect you're going to see it far less often, but it is still there. So you need to be aware of that for individuals. We still have an AMT. Another big thing that happened, also included in this bill, we did set. Now, we call elimination, they've called elimination shared responsibility payment, but in reality, what they did was they set it to zero. All the plumbing's there. Everything's there to put it right back in the law. Just put the amount in there. It's right back in the law. We keep going. Shared responsibility payments back in the law. Still, technically, everybody's supposed to buy insurance or they're subject to the penalty. The catch is the penalty is zero. And the other catch, remember, is it's effective for months beginning after December 31st, 2018. I think a lot of taxpayers are going to hear this and think, and especially because this came out on the last day for signing up on the exchanges for healthcare. They'll say, oh, no, they got this all done, and they're going to get rid of this, so I don't need to have the coverage next year. Any taxpayer that thought that is going to be in for a rude surprise, right? It's like, no, the penalty will apply for 18. It won't apply for 19, but 18 it applies for. So again, one of those things to watch for. We've known that all along, but I have not heard the press be clear about when this elimination would take place. The public press, and I'm talking about the press all the way from the general press, the CNNs, Fox News, etc., all the way to the Wall Street Journal, financial press. It's like everybody's kind of skipped over the fact that, wait, there is still going to be a year of this, guys. People need to understand that it won't go away till 19. Well, as we said, we'll see how that works. Well, this concludes our first half of the discussion of the law. We're going to do the business ones here in the second show. But again, please remember, these are brought to you, and I can do these because of all the work that your state society of CPAs do in allowing us to present these courses and get courses ready. We're going to be working with those state societies because, by the way, next season, expect a lot of discussion about this tax law because we have to figure out how to implement, how to plan using this thing next year. Right now, we're scrambling for what you do at the last second once you figure out what's happened. But obviously, there's a whole bunch to dig into here. And I haven't even touched on the business items yet. So be sure to take a look. Your state society, some state societies have now finished their catalog for the year. Others have some stuff going on in January. Take a look. I'm going to be doing sessions in January for Arizona and for New Mexico. And I'll actually be doing sessions in mid-March in Oregon for people in industry, talk about their tax issues, or should say mid-March, mid-February. I will also be doing, for those of you in Arizona coming up, it's on their schedule, I'm going to be doing a 4-hour session of this. We're doing it on a Friday afternoon, right after Gil finishes his ethics session. I'll come in that afternoon. I'll be doing the session on the new tax law. So we're going to talk about those 4 minutes. That is January 26th. I got to remember my dates. It's a Friday. So, but you go on the Arizona website, you'll find it. It'll be both at the Society's office and broadcast. So we can get it both ways to you. But we're working on those, and obviously we're working with the societies for what's going on next year. Be sure to take advantage of that. Support the work they do. What they do also helps, and I'll tell you very much, I think, all across the country, dramatically in getting state tax laws, keeping state laws out that aren't as really weird as they could be. And believe me, that's an important feat that they do, giving input to the states so that we get something at least operational out of the system. This has been the first part of the update for the week of December 18th, 2017. Be sure to check us during the week. We'll post some updates for you at currentfederaltaxdevelopments.com. You'll be able to download a PDF with the slides from this session. I will post that up this afternoon. And, any questions or comments, you can send to me, Ed Zollers, currentfederaltaxdevelopments.com. On Twitter, you can follow me at Ed Zollers. Otherwise, stay tuned. Hopefully, I'll get another session up here by the time this day is over. I'm about 2:30 right now, so we'll see if I can. We'll see if my voice lasts to get through the rest of it, and I get through the corporate side. But hopefully, we'll get that up, and we'll get you the other half of this. And otherwise, in any event, have an enjoyable holiday season. Take some time, relax, and we'll see you back. If not, probably I'll have to do a show right after the Christmas date, because that'll be the actual bill, and we have some updates to talk about. But if nothing else, if you don't hear it till then, and I don't hear you until after the beginning of the year, have a fun, happy holiday season, and I look forward to seeing you in 2018.